Gold has done a great job, and I'm delighted. Well, I'll give you some arithmetic. If I was on Adam Taggart's show and one of his readers said to me, Rick, when is the gold price finally going to move? I would say to that person, I'd be old and sage, it's going to move in the year 2000. In the year 2000, it was at $253 an ounce. Now it's at $2,600. In other words, it's up, what, sevenfold? Yeah. Gold has increased by almost 8.5% compounded for 24 years. It's done exactly what it was supposed to do. It's protected by purchasing power for 24 years. So when you're asking me when gold's going to move, 24 years ago. What I really like about it from an investment perspective is that it has this wonderful track record, which nobody cares about. The market share of precious metals and precious metal securities in the U.S. market, the market that I know the best, is less than 0.5%. Less than 0.5% of savings and investment assets in the United States are precious metals related. The 4-decade mean, according to J.P. Morgan Chase, not some old bald gold bug, J.P. Morgan Chase, is that the market share of precious metals and precious metals securities over the last 40 years in the U.S. market has been 2%. Gold doesn't need to whip the U.S. dollar. Gold doesn't need to break the treasury market. All it has to do is revert to mean. If it reverts to mean, the market share in the U.S. market grows fourfold. Now, can you imagine what a fourfold increase in demand for gold and gold stocks in a market that controls 23% of the savings and investment assets in the world would do to the gold price? You know, Bitcoin is what, a $3 trillion asset class? Robert Friedland describes that as a pimple on an elephant's ass. Yeah. And the crypto moron are very similar species. But if you look at a global market for savings and investments at the $750 trillion level, gold is a sideshow and Bitcoin is a sideshow. They don't matter. The circumstance that will cause the gold price to move is a circumstance where perhaps Bitcoin can be accommodated in the move too. My suggestion is that they serve different purposes. Right. Gold is a store of value and a medium of exchange. Bitcoin is a network and a transfer mechanism. So I think at their heart, they're different asset classes. Right now, they're regarded as momentum. They're regarded as trading vehicles. I engage in conversations here with people about Bitcoin, and I admittedly know almost nothing about it.
They must love you.
And I would suggest that I know substantially more about it than they, and they're advocates. Despite the fact that I know more about it than they do, I profess no knowledge. The real knowledge they have is that they've watched it go from 1,000 to 100,000. That's the whole knowledge. And the fact that the asset class is up 100-fold, they somehow think makes it more attractive. Well, let's say that your fiance went to the grocery store and the price of bananas was up 100-fold. She would be very logical and not buy bananas. But because an asset class is up 100-fold with no demonstrable change in utility.
Rick Rule's insights paint a compelling picture of the current state of the global economy, the dynamics of precious metals, and the path forward for investors seeking financial resilience. Over the years, gold has demonstrated its value as a reliable store of wealth, and yet it remains vastly underappreciated in mainstream investment strategies. Gold's performance since 2000 is a testament to its resilience. From a modest $253 per ounce to today's levels nearing $2,600, gold has achieved a 7-fold increase over 24 years. That's an annualized return of nearly 8.5%, quietly outperforming many traditional investment vehicles while protecting purchasing power against inflationary pressures. Yet the broader market remains largely indifferent. As Rule humorously notes, gold's historical performance is akin to a brilliant student whose achievements no one applauds. The lack of interest is not surprising when considering the negligible presence of precious metals in the average American investment portfolio. According to J.P. Morgan Chase, less than 0.5% of U.S. savings and investment assets are allocated to precious metals or related securities. Compare this to the 40-year average of 2%, and the potential for growth becomes evident. If gold were to revert to its historical mean market share, demand could quadruple. Given that the U.S. accounts for approximately 23% of global savings and investment assets, this increased interest could have seismic effects on the price of gold and related equities. Gold doesn't need to outperform the U.S. dollar or destroy the treasury market to thrive. Instead, It simply needs a modest increase in adoption. For context, the global savings and investment market is valued at an estimated $750 trillion. In this immense ocean of capital, gold is but a drop, and yet its potential impact is monumental. Bitcoin, often positioned as gold's digital counterpart, has drawn significant attention in recent years. While its market cap hovers around $3 trillion, Rule likens it to a pimple on an elephant's rear when compared to the vast global savings pool. He is quick to highlight that gold and Bitcoin serve distinct purposes. Gold is a proven store of value and medium of exchange, while Bitcoin operates primarily as a digital network and speculative trading vehicle. The narratives surrounding these assets may intertwine, but their roles in the financial ecosystem are fundamentally different. Interestingly, public fascination with Bitcoin often stems from its meteoric rise rather than any intrinsic utility. As Rule quips, if the price of bananas rose 100-fold, you wouldn't buy bananas. But with Bitcoin, people see the price increase and jump in. This herd mentality underscores the speculative nature of many digital assets, contrasting sharply with gold's enduring stability. The broader economic landscape further bolsters gold's appeal. The U.S. faces a fiscal conundrum, with debt-to-GDP ratios exceeding 120%. The only viable paths out of this predicament are politically challenging spending cuts, outright default, or inflationary measures to erode the real value of obligations. Rule points to historical precedent. In the 1970s, the U.S. reduced the purchasing power of the dollar by 75% over a decade, coinciding with gold's rise from 35 to 850 per ounce. Inflation is not just an economic phenomenon, it's a policy tool. By honoring nominal obligations while eroding their real value, governments can effectively manage debt. However, this approach disproportionately impacts savers and wage earners, transferring wealth to borrowers and asset holders. For those unprepared, the coming years may prove financially devastating. Gold and silver offer a hedge against this erosion. As tangible assets with intrinsic value, they remain immune to the whims of central banks and policymakers. Unlike fiat currencies, they cannot be printed at will. This scarcity ensures their enduring appeal as safe havens in times of economic uncertainty. Rule's reflections also delve into the broader societal implications of economic policy. While headline numbers like GDP growth and stock market performance suggest prosperity, the reality for many Americans is starkly different. Access to artificially cheap credit benefits the wealthy, enabling them to accumulate assets and build wealth. Meanwhile, those without such access struggle to make ends meet, bearing the brunt of rising costs and stagnant wages. This disparity underscores the human cost of economic mismanagement. It's not just about numbers on a spreadsheet, it's about livelihoods, opportunities, and the erosion of the middle class. For Rule, acknowledging this reality is crucial in understanding the true state of the economy and the importance of sound money principles.
The probability that Trump actually cuts spending. When you look at the range of campaign promises that he made, it's obvious that he wasn't really campaigning on cutting spending. He was campaigning perhaps on cutting spending to constituents that didn't vote for him, but that's not the same thing. If you were as old as I, and I realize you're not, you would have experienced this once before during the Reagan Revolution. Reagan came to office with a much stronger mandate than Trump to dismantle government, reduce the size. There's a wonderful book called The Triumph of Politics by David Stockman that describes the derailment of the Reagan Revolution within 180 days of them taking office. Think about empowering a government agency, the Department of Government Efficiency. Yes, you're creating a government department to reduce government departments. Think about that. The probability of them achieving that, I believe, is zero. As to your first question, how do we get out of this? I think, unfortunately, the answer to that is clear from history. We faced the same circumstance, although less dire, in the decade of the 1970s. And what we did is we honored our nominal obligations. In other words, some old codger like me, who's getting, I don't know what I get, $4,000 a month in Social Security, I'll continue to get $4,000 a month, but $4,000 won't buy $4,000. We will honor the nominal amount of our obligations, but we'll inflate away the net present value of the obligations. The US government themselves suggest that in the decade of the 1970s, the last time we faced this circumstance, the purchasing power of the US dollar was reduced by 75%. Not coincidentally, during that period, the gold price went from $35 an ounce to $850 an ounce. Yes, the two events were related. The only way that I understand that we get ourselves out of our debt crisis while politically honoring the nominal value of our obligations is to inflate away the net present value of those obligations. I believe, I'm not an economist, I'm a credit guy. Right. I believe, just from talking to people, that people's expectations of the future were formed over the last 40 years. Probably the easiest times in humankind. The nominal interest rate, the real interest rate were falling. The US government was able to export inflation to other countries because of our currency. Right. We had the benefit of the good parts of globalization. We had the benefits of world trade. Unfortunately, I think most of that came to a screeching halt beginning 2022. I'm struck that most people don't understand the difference between solvency and liquidity, which is to say somebody who has a $700,000 home mortgage, $100,000 in credit card debt, whatever it is, they're making $70,000 or $80,000 a year. If they have $10,000 in their jeans, they can afford today's bills. They're maybe going to lose their house. They're maybe going to go upside down in credit card debt, but today they can buy a hamburger. I would describe the circumstance that we're in today as that same thing. We're confusing liquidity, the fact that there's cash in the system, with solvency. The second thing is that we are in an economy that is doing reasonably well. It's just not doing reasonably well for most people. If you're Rick Rule and you have access to credit, credit's artificially cheap. And if you understand how to use the credit, this economy, for people like me, is spectacular. This economy, for people who don't have access to credit or don't know how to use credit, people who are more focused on their lifestyle and on their family than they are their finances, this economy is not working for them. And we need to understand that there is a human cost to the economy that we're in, irrespective of the fact that the headline numbers are pretty good.
Rick Rule's analysis of the global economy and the role of precious metals underscores one critical reality. Gold and silver are more than just commodities. They are lifelines in an increasingly volatile financial world. As we navigate through mounting debt, inflationary pressures, and central bank interventions, the case for owning gold and silver becomes not just compelling, but essential. The Federal Reserve's balance sheet expansion has been nothing short of historic, and Rule's prediction that it could exceed $20 trillion in the next crisis is not hyperbolic. To understand why, consider the trajectory of monetary policy. During the global financial crisis, the Fed's balance sheet ballooned by $3.5 trillion over several years. During the COVID-19 pandemic, it expanded by nearly $5 trillion in just 18 months. Each successive crisis demands more drastic interventions, and with debt to GDP ratios now exceeding 120%, the Fed will have no choice but to resort to the big print. This relentless expansion of money supply has profound implications for the dollar. While the dollar's dominance as the global reserve currency has persisted for decades, cracks in this foundation are becoming increasingly visible. Major economies, particularly those aligned with BRICS nations, are diversifying away from the dollar. Central banks globally are accumulating gold at record levels, signaling a shift in reserve asset preferences. As Rule aptly points out, these moves are not random. They are calculated responses to the erosion of trust in fiat currencies. While gold often takes the spotlight, Rule is quick to highlight the unique potential of silver in this environment. Silver's dual identity as both a monetary and industrial metal creates a dynamic that gold cannot replicate. On the monetary side, silver provides a more accessible entry point for smaller investors. Its historical role as the poor man's gold means it often outperforms gold in percentage terms during bull markets. From an industrial perspective, silver's applications are expanding rapidly. The global push toward renewable energy, particularly solar power, is a significant driver of demand. Silver is a critical component in photovoltaic cells, and as countries strive to meet ambitious climate goals, silver demand will soar. Additionally, advancements in technology, from 5G infrastructure to electric vehicles, are creating new avenues for silver consumption. Rule draws parallels between the current state of the silver market and the uranium market a few years ago. At that time, uranium was languishing at historically low prices due to oversupply and weak demand. However, as secondary supplies were exhausted and new demand emerged, uranium prices skyrocketed. Similarly, the silver market is now in a structural deficit, with demand outstripping supply. Secondary sources, such as recycled silver, are finite and dwindling. Once this cushion is gone, prices could experience a rapid and sustained rise. Rule's projection of silver prices reaching triple digits in this cycle may seem bold, but it is rooted in fundamental analysis. The gold-to-silver ratio, which currently hovers around 80-1, is far above its historical average of 15-1. As the ratio normalizes, silver's upside becomes even more pronounced. A return to a 40-1 ratio, for instance, would imply a silver price of $65 per ounce if gold remains at $2,600. If gold were to rise to $4,000 or higher, silver's potential becomes even more staggering. Despite these strong fundamentals, public interest in gold and silver remains muted. Rule attributes this to a combination of complacency, ignorance, and distraction. Mainstream investors are often drawn to assets that have recently outperformed, such as tech stocks or cryptocurrencies. This herd mentality overlooks the critical role of precious metals as long-term stores of value. Rule humorously compares Bitcoin's meteoric rise to a hypothetical scenario where bananas increase in price by 100-fold. In such a case, a rational consumer would avoid buying bananas, recognizing the absurdity of their valuation. Yet with Bitcoin and similar assets, many investors interpret price increases as a reason to buy, ignoring the lack of intrinsic utility. This speculative behavior contrasts sharply with the disciplined, value-oriented approach that gold and silver demand. The lack of interest in gold and silver is also evident in the underperformance of mining stocks. Historically, mining equities have delivered leverage to the price of metals, often rising 2 to 3 times as much as the underlying commodity during bull markets. However, in the current cycle, mining stocks have lagged, reflecting skepticism about the sustainability of gold's rise. Rule believes this disconnect presents a significant buying opportunity. As the reality of inflation and currency debasement becomes undeniable, institutional capital will flow into the sector, driving mining stocks to new heights. One of Rule's most critical insights is the inevitability of inflation as a policy tool. Governments face an unenviable choice: either default on their debt outright or inflate it away. The latter option, while less honest, is politically expedient. By maintaining nominal obligations while eroding their real value through inflation, governments can effectively reduce the debt burden. However, this approach comes at a cost, disproportionately affecting savers, wage earners, and retirees. The inflationary pressures of the 1970s offer a historical parallel. During that decade, the purchasing power of the US dollar declined by 75%, and gold rose from $35 to $850 per ounce. Rule argues that we are now on the cusp of a similar scenario. The conditions that supported dollar stability over the past 40 years, low interest rates, globalization, and trade surpluses, have largely evaporated. As inflation accelerates, gold and silver will serve as lifeboats in a sea of devaluing currencies. Rule's perspective on gold extends beyond its role as a hedge against inflation. He envisions a future where gold reclaims its position as a global currency. This transition would require a significant revaluation of gold to reflect its true value as a monetary asset. Some analysts, including Rule, have speculated that gold could be revalued to levels exceeding $10,000 per ounce to anchor a new financial system. This possibility is not as far-fetched as it may seem. Central banks are already preparing for a potential reset. The Bank of International Settlements, BIS, has reclassified gold as a Tier 1 asset, placing it on par with cash and sovereign debt. This move underscores the growing recognition of gold's importance in a world facing monetary and fiscal instability. For investors, the implications are clear. The time to act is now, while gold and silver remain undervalued and underappreciated. The window of opportunity is narrowing, but for those who recognize the signs, the rewards could be immense. Rule's wisdom reminds us that successful investing often requires going against the crowd. In a world obsessed with short-term gains and speculative bubbles, gold and silver offer a rare combination of stability and upside potential. They are not just assets, they are safeguards for an uncertain future. As Rule concludes, gold has done exactly what it was supposed to do: protect purchasing power. The question is not when gold will move, but whether you are prepared when it does. For those willing to embrace this perspective, the future is golden, literally.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.